I posted my initial Dropbox analysis on December 9th. Since then, the share price has continued to tread water in the low $20 range, and yet the fundamental outlook has only improved. I am more bullish on Dropbox now than I was then, and I continue to add to my position at these bargain prices. So Dropbox recently reported earnings, which were pretty great, beating estimates across the board for EPS, revenue, paying users, and ARPU. And yet the stock fell on the conservative guidance management gave for 2021. And Dropbox management has always given conservative guidance. That's why they've managed to beat earnings estimates 12 out of the last 12 quarters. But I think the most important announcement we got that the market isn't taking into account is their plan to repurchase an additional $1 billion in shares on top of the $220 million they repurchased last quarter and the roughly $200 million they plan to spend by the end of Q1 2021 under their existing share repurchase plan. I mentioned in my previous Dropbox analysis how share buybacks could be a bullish catalyst to improve Dropbox's long-term EPS growth, and judging by their recent actions, it looks like management agrees with me. It is for this reason that I'm actually hoping the share price stays down in the short term. Management clearly agrees with me that their company is highly undervalued, and the lower the share price is, the more management can buy back. Given the fact that Dropbox is currently valued at around $9.5 billion, a $1 billion buyback plan is actually a really huge amount of shares that could be taken off the market. Though after accounting for stock-based compensation, the reduction in share count won't be quite as large. The guidance given for full year 2021 was between 402 and 407 million shares outstanding, which would represent a decrease of about 7 million shares from their most recent weighted average shares outstanding number provided for Q4 2020. I am using the midpoint of this guidance, or 404.5 million shares outstanding, for my estimates. I think that going forward, management could easily continue to take 4 to 10 million shares off the market every year, purely using their free cash flow if the share price were to continue to flounder in the $20 range. I'm conservatively estimating a 1 to 2% reduction in shares outstanding annually over the next 5 years, and have baked that into my forward estimates, which I will get into more later in the video. In order to fund this share repurchase plan, management also announced the issuance of convertible notes for proceeds of $1.3 to $1.4 billion. For those of you who don't know, convertible notes or convertible bonds are a form of debt where the principal can be repaid in shares of the company's common stock instead of in cash. In Dropbox's case, half the notes are due in 2026 at a conversion price of $38.25, and the other half are due in 2028 at a conversion price of $35.35. Aside from this conversion premium, the notes bear no interest. I think this is an incredibly smart move by management. They believe that Dropbox stock is going to be much higher in the future, so what they're doing is issuing debt to raise capital so they can buy shares at currently undervalued prices. Then when the debt matures, they will issue shares to repay it at much higher prices. Essentially, they are selling future shares in the high 30s so that they can buy back shares right now in the low 20s. Of the $1.2 to $1.3 billion they are raising, $200 million is immediately going into share repurchases. A further $58 million is going into hedging for the purchase of warrants. Warrants are essentially long-term call options on the stock that will convert at a price of $46.36. They purchase these warrants to help hedge the risk of future shareholder dilution. Now this leaves them with over $1 billion in cash remaining, on top of the $1.1 billion that they already had on their balance sheet. So right now, Dropbox has over $2 billion of cash, or roughly 22% of their entire market cap, that they can use to both expand the business aggressively and repurchase shares. So that brings me to my updated financial projections for Dropbox. As always, I like to remain conservative in my outlook, especially in regards to paying user growth, which has continued to decelerate in line with my expectations. But nonetheless, I have raised my base case for 2025 EPS by 26% to $2.26, which is also 12% higher than what analysts are currently projecting. These estimates are based on a variety of assumptions which I consider fairly conservative, including ARPU growth of 3.5% and paying user growth of 7%, both of which are below historical averages and below the numbers they posted in the last quarter. If you'd like to look at all my assumptions, go ahead and pause the video here. Moving on to price targets, analysts are currently expecting 16.8% annual EPS growth over the next 5 years, or $2.02 in 2025. I'm assuming a fair trailing PE for Dropbox in 5 years would be around 22, which I think is conservative for a more mature, highly profitable cloud and software company, especially considering big tech is still trading at PE ratios in the 30s, even after the recent market correction. This valuation could certainly expand if management is successful in their transition into an integrated, distributed workplace platform. This type of software and subscription-based business model with high reoccurring subscription revenue tends to command a much higher valuation than Dropbox is currently getting. So based on analyst estimates, which I don't think are nearly bullish enough, especially considering Dropbox's stellar track record of beating earnings estimates, we'd be looking at a share price of around $44, representing about a 90% upside over the next 5 years, or around 13.6% annualized. Using my base case of $2.26, Dropbox would hit $50 a share, representing about a 16% annual return. If Dropbox performs better than I'm expecting, I am targeting $2.56 on the high end. This would yield a share price of $56 and about a 19% annual return. And even if I am wrong, and the analysts are wrong, and Dropbox's growth slows dramatically, I still believe that there is an 80% plus chance they will deliver at least 11 to 12% returns annually at a bare minimum. In my opinion, investing in Dropbox is one of the best risk-reward opportunities in the stock market right now. I am quite confident that Dropbox will return at least 15 to 20% annually over the next 5 years, but it is always important to examine the risks and consider the bear case against any investments you make. So what scenarios could prevent this investment thesis from playing out? Well, for one thing, it is possible we could see a general market valuation collapse. If the stock market were to go into a multi-year downtrend and valuations on companies got cut 30 to 50%, then Dropbox would likely return very little, if anything, over the next 5 years. In this scenario, I still think that Dropbox would vastly outperform the market, though, simply due to the fact that they are already much more fairly valued than most of their peers in the broader market. We have seen a bit of this emerging already recently. As the high-growth, high-valuation tech stocks have tumbled, Dropbox has performed better on a relative basis. If we take a look at Dropbox's recent performance versus the QQQ, we can see that they've started to diverge during this correction, and I think Dropbox will continue to outperform in a downtrend, and regardless of the market direction, I believe Dropbox will provide better returns over the next 5 years. The only other real risk I see for Dropbox is if they fail to execute in a major way. Dropbox's business model depends on 2 fundamental factors. First, they must continually convert more users into paying customers, and second, they must increase the average amount each customer pays Dropbox for their services. Paying user growth has continued to decelerate over the last few years, down to a year-over-year gain of 18.18% in the last quarter. ARPU has been much more steady and has continued to grow around 3 to 6% annually over the last 3 years. These 2 metrics are sort of in opposition to each other. For example, if Dropbox reduced their prices, their growth in paying users would jump up, but their ARPU would decrease. The challenge will really be to continually innovate and improve the platform's services enough to justify a higher price tag. If management were to simply continue to raise prices without improving their product, their paying user growth would dry up and their churn rate would start to rise as more customers started seeking cheaper alternatives. In this scenario, management would likely have to ramp up marketing spend, which would increase expenses to drive incrementally less growth, leading to lower long-term profits and a lower valuation. This is the only real scenario I see that could lead to a negative return in this stock over the next 5 years, and I think this outcome is highly unlikely. This is a founder-led company. The current CEO, Drew Houston, co-founded the company in 2007 when he was 24. He owns over 10 million shares of Dropbox, and management as a whole receives a large portion of their compensation in the form of equity in the company, so their incentive for the share price to increase is very much aligned with shareholders. So far, management has shown themselves to be very financially disciplined. Operating expenses have actually decreased over the last 3 years, even while revenues and profits have grown significantly. So I don't think expense growth will accelerate significantly in the future. Cost of revenue, or cost of goods sold, has actually been shrinking over the last 3 to 5 years in real terms after accounting for inflation. I am anticipating that revenues will continue to grow at around double the pace of operating expenses and cost of revenue, which should lead to significant margin expansion that will help management reach their targeted goal of $1 billion in free cash flow by 2024. So, all things considered, if you're looking for an undervalued growth stock with a great risk-reward profile, I would consider investing in Dropbox. This video isn't financial advice, and you should always do your own research, but I am quite confident in my projections for Dropbox over the next 5 years. Let me know if you guys are buying Dropbox or any other stocks right now in the comment section below. If you enjoyed the video today, don't forget to leave a like and subscribe for more future content like this. I hope you guys have a great day. I will catch you in the next video.